Hello, I'm Marianne Deveni. Well, we expect when we invest in a stock with more risk, say in the tech sector, to get a higher return. But does that always hold true? Well, I'm joined today by Jean Masson on Skype from Montreal. He is the head of quantitative research at TD Asset Management. Well, Jean, you've actually brought me a chart as well, which is quite interesting. Let's start off with that. What does this tell you about what's happening with risk and return in the Canadian environment?
So this is the result of a little exercise we did. Basically breaks down the constituents of the S&P TSX composite index. So that's an index of roughly 250 stocks. And we divided it into 5 portfolios based on historical volatility. So the leftmost portfolio is made up of the least volatile stocks, things like food stocks, railroads, telecoms, and so on. The next might be commercial banks, insurance companies, and so on. And then at the far end, you'd have the high-tech stocks. So in Canada, we had Nortel for a while, BlackBerry currently, Sino-Forest, a lot of small mines, and so on that are more volatile. And what you have there is the annual return on these portfolios over the last 23 years. And obviously, the most volatile stocks posted negative returns over this period, while all the others posted reasonably nice returns, positive returns.
Right. And you were telling me that although this is over 23 years, in a shorter time period, it could be different.
Oh, yeah. This is a long-term average. And in the literature, actually, people have documented similar type of pattern in, let's say, U.S. equities over much longer periods, periods as long as 85 to 90 years. But so over these long periods, that kind of pattern seems to hold from one equity market to the next. But over shorter periods, that's not what we observe. For example, when equity markets pose very strong returns, as we observed, let's say, last year in Canada, then that's when the riskier equities tend to outperform. So over short bursts of nice market performance, you'll have riskier equities actually delivering better returns. Otherwise, over a full cycle that includes some downtimes, they don't.
So that's really important for an investor to remember when they're looking at their portfolio. With such little volatility that we're seeing right now, or at least a lot less compared to historically, why would you say it's important to investors to pay attention to their risk levels?
Because if risk is not properly compensated, unless you really enjoy taking risk for its own sake, unless you're the kind of person who crosses the street without looking, just for the kick. Basically, most people don't like risk, and for some reason, risk has not been compensated. So you might as well take little. We know, what the evidence shows is that in the history of financial markets, less risky equities have delivered just as good returns. There's no need to take a lot of risk. You could take a lot of risk by investing in a single stock, especially a single tech stock. But even at the portfolio level, the portfolio of just tech stocks would be pretty risky and historically would not have done very well.
So we're kind of back to not putting all your eggs in one basket. Do you have some examples of names of sort of low volatile stocks?
I think for sure in Canada, let's say the commercial banks, so CIBC, Scotia, TD, RBC, they're less volatile than the typical stock. So are many of the insurance companies like Intact. So are the grocery stores, Metro, Loblaws, Empire. So are drugstores. Even railroads, CN, CP, are not very volatile. So the telephone companies, BCE, TELUS, Rogers, not very volatile just by nature. People don't suddenly consume twice as much cell phone time when times are good, or they don't cancel all their subscriptions when times are bad. Another low-vol name might be Tim Hortons. Same thing at the global level. The firms that provide food, drinks, utilities, and so on tend to deliver less volatile returns.
That's a very long list. So there's definitely a lot of them out there. My last question was just if you look ahead, you say there is mean reversion in the market. What do you see for the outlook for volatility? Is it going to go back up?
So eventually it will go back up. When you look at volatility over long periods, let's say 10 years, in Canada it tends to be a number close to, let's say, 15% for standard deviation of annual returns. Lately, in the last 4 or 5 years, we've seen numbers closer to 10%, so roughly 2/3 of normal volatility. We expect volatility to eventually go back to 15%. Will it be in 2015? Will it take another year or two? It could possibly be, but this is as long an episode of low volatility as we've observed in history. So I think eventually it will come back. We just need a crisis to generate this, or it could be technological change. It could be, many things, interest rates going up. But I think eventually volatility will come back.
All right. Well, thank you very much, John. It's definitely good to pay attention to your appetite for risk and know when to get in and when not to get in when you're investing. Well, thank you very much. I've been joined by Jean Masson, who is head of quantitative research at TD Asset Management, joining us via Skype. Thanks for watching.